If you cannot see the liquidity, you are the liquidity. Now, before we get into this video and you start to understand the importance of inducements, this is not another one of those SMC sweep guides, those liquidity run buy side, sell side liquidity. Because if you're one of those traders that is trading sweeps, I would say you're halfway there. You're close to where you need to be. But a lot of the times you won't understand your losses. A lot of the times you'll think you got it right, you saw the sweep, and price goes against you anyway. It means you have a win rate in the floor. You're frustrated because you keep blowing accounts, and most importantly, you don't understand why the market is doing what it's doing. And myself, after nearly a decade in the markets, making millions of dollars from high quality intra-session scalping, I've started to realize that most traders are looking at the wrong thing. And I can tell you firsthand from these institutional traders that I've spoken to on my podcast, not a single one of them understands SMC. Not a single one of them utilizes the same ways retail traders are looking at the market. And in this video, I'm going to be breaking down and sharing a no BS guide, the realities of inducements, a term that I pioneered in 2019, but I'm actually going to be revealing to you the exact criteria and showing you through a walkthrough of this week's price action, how often they appear and how they supersede market structure, supply and demand, and all these other trading terminologies. And therefore, this is not just theory. This is a real life walkthrough of real life price action, not only of just this week that I'm going to share with you, but the last 2 years on this channel that I've made endless case studies showing you time and time again that inducements is the truth, inducements is the only way. And if you're still skeptical, we'll take my public track records, my public documentations, and my public live signals where I've given my trades live ahead of time for the public to follow along for free. And I've been able to gain over 57%. Plus you've seen my Brokerson journal, plus you've seen my MyFX book. There is absolute transparency on my side to show you that this is the truth of the market. So join me in this video as we learn how to read the language of price action, so you can start to understand professional trading in a way that no one else is talking about. So this inducement guide, the first thing I want to categorize to you is the types. We have a minor, medium, and major inducement. Now, each one has their purpose, each one has their criteria, and I'm going to be sharing with you how to identify them and use them in your own trading. Obviously, it goes without saying that a minor inducement is the least relevant one, still important, but these are going to be related to smaller movements in price. Whereas if you come to a major inducement, yes, they'll be less often, but they'll be a lot more impactful, a lot more meaningful, and lead to far greater quality setups. And as we move along, we're going to understand the types of inducements and where they appear, where they can appear inside of a point of interest, but they can be an inducement of a point of interest, or they can be with no point of interest involved. So it's contrary to just supply and demand trading or just market structure, because you can understand market movements when you're in no man's land in a market structure push. And before I get into sharing all of these things that I have to with you, I want to remind you of previous videos where this was one of the previous videos we spoke about. And remember, this mind map we've been covering for a few weeks now. We've been getting into excruciating detail with all the guides that we've been doing over the last month. And remember, from the liquidity trading guide, we spoke about manipulation, which in other terms is an inducement, reminding ourselves that the law of cause and effect. When you have an elastic band and you pull it back, that is the cause. When you let go of that elastic band, you would expect it to ping forward as opposed to just dropping. Similar mindset for inducements. When you have a correct manipulation after a correct build-up, the build-ups are going to be all of these. You can have a support and resistance trap. You can have a trend line trap. High of previous day, low of previous day, high of previous week, low of previous week, intraday structure, major structure, session highs and lows, traps. There are so many things to consider when you talk about liquidity, because there are so many participants and strategies and ideas and psychology involved in the market. These will all contribute towards build-ups and liquidity, and therefore manipulations will target all of them. And the ones that you want to trade are those inducements of maximum impact. So when we can combine a lot of these things together, that's when we know we have really pulled that elastic band. We really have found high probability liquidity. We go for the inducements, and then I'll show you how to confirm it. And we spoke about it briefly last time with the qualification criteria and the invalidations, but let's discuss it today in a whole lot more detail. So let's walk through the types of inducements as I mentioned. First, we have the minor one. Now, the minor one has a purpose. It's not something to neglect, but it's important to realize minor inducements alone do not lead to trade setups. They give you an idea of intention, of control on what can happen next. So you utilize this like your letters in the alphabet. You utilize it to understand the words, understand the sentences, and this is going to be the signs of how to read price action, but that doesn't mean how you trade. And you realize that these minor inducements are happening all the time, constantly, and they have small buildups, usually on a lower time frame like M1, and they have a spike down to grab liquidity, and then they lead to a push out, usually breaking structure. They come back from mitigation, and then they continue on. But these ones are very short-lived. For example, let's say you have a buildup of liquidity of highs over here, and then price is coming lower, and then we do a little build up here. The minor inducement might just grab liquidity down here simply to fuel price to grab this liquidity. Once we've grabbed the liquidity up here, this minor inducement now has served its purpose. It did its job. And now a new market movement can come in and maybe we take it out because we grab liquidity from this zone over here. So minor inducements are short-lived. They sometimes facilitate price movements. They sometimes facilitate the real inducement of the day. So these can be quite misleading. Smart money traders, they're usually putting too much emphasis on the wrong ones because they don't understand the inducement of the day. Because the reality is once you have found that inducement of the day, say it like this, when you have the follow through, you will have continuations of small minor inducements where it will build up again and again, do a minor inducement and continue lower, build up again, maybe invite in buyers from this zone by inviting them in, giving them reaction, inducing, and then continuing lower. The way I like to look at it is you find the inducement of the day and then you use the minor inducement as your dominoes. And as they say, when the first domino falls, the next one and the next one and the next one follows. So you find the inducement of the day and then your minor inducements show you control, confirmation, continuation, and these can help you understand profit-taking systems or re-entries or confirming your bias. But generally speaking, minor inducements are short-lived movements, short-lived objectives and intent, and very small impact liquidity runs. They're not grabbing a whole lot of liquidity. Maybe it's just a very local build-up like a triple bottom on the M1 time frame that we just induced to allow price to come higher. Now, the next category up is going to be our medium inducements. This is when we start to come to a slightly higher time frame. I usually look at intraday price action as opposed to intra-session price action from the minor inducements. Here, when we arrive to, let's say, an M15, we're looking at more market structure orientated moves, more Asia high, Asia low related, previous day high, previous day low. I'll show you a category in a moment, but you'll realize that it's a very similar signature. You'll have a build up on slightly higher time frame. You'll have an inducement that will lead to a intraday push, an intraday market structure movement. And in this case, somebody can really simply say, well, this is just bullish price action. It's just higher highs and higher lows. Yes, when market structure and inducements align, they lead to great opportunities. But many times, especially if you're a market structure trader, you'll know this. You'll be doing everything right from market structure and still taking losses. Because when inducements are not aligning with market structure, the inducements will overpower and you will take losses. So it's important to either understand how to connect them or rely only on inducements to know who's in control and where the market will go next. Because inducements, they are the liquidity, they are the fuel of the market, the oxygen for the market. Without this fuel, the market doesn't move. And the importance with a medium inducement is that these are enough to qualify some types of setups. Therefore, this is going to be the basis of not just reading price, but actually taking the understanding to quality setups. And then lastly, we have our major inducements. Major inducements, let's say you have a daily or 4-hour point of interest. Price arrives to that point of interest and we get some reactions, we get some consolidation. It taps in once, it taps in a few more times. And if you take a look on a lower time frame, let's say an M5, you can see price came in once, gave a reaction, invited in all of these sellers. What happened there? Liquidity. So just like here, we can see we had a buildup of liquidity. We had an inducement to do what? Grab these highs. Same again, when we have this trend line liquidity that we see right here, what happens? We induce these lows, we grab the liquidity right here to push higher. So basically the market is engineering liquidity by all of these sellers entering the market because of the trend line, by an early tap into the supply zone. And then the inducements over here, they wipe those areas out. And we see it again where the market is coming lower. We're giving a break of structure, but the reality is we are grabbing liquidity from this area. This inducement pushes market higher once again. And eventually we'll get an inducement of the whole point of interest, the whole daily or 4-hour time frame supply zone. When you take out a major point of interest, there's a whole lot of liquidity in that zone that we just captured. New fuel to make a new move in the market. And when you have the confirmation of a break of structure, then you have found the inducement of the day for sure. And just for your understanding, why does this even work? Let's say we have a build up like this. We have a triple top. This has now been 1 touch, 2 touch, and 3 touch. When the market returns over here, a lot of sellers are going to be entering on the 4th touch, just based on a resistance level. If we are inside of a supply zone, then we have the stop losses of supply and demand traders. If we are in a supply zone, then we have the stop losses of not just the resistance traders, but also the supply and demand traders. And we start to realize there is going to be a whole lot of liquidity in this zone. Now, as the market comes lower and we start to get bearish price action, we're going to get even more sellers getting involved because of this trend line. And then let's say market even breaks lower, we give a break of structure, then we're going to get another supply zone forming and we're going to have even more stop losses in this area. When market returns, sellers are going to be loading up. So we have so many stop losses in this area, and this is just one example. We could have Asia high, previous day high, we could have smart money trap. There's so many types of liquidity, but in the end, what happens? When we take it out, we have grabbed all of this liquidity that we can see on the left. But that's not all, because now certain traders think we've had a run of liquidity low, we've had a higher high now, we've had a bullish break of structure. They're looking for higher low to then look for buys to continue higher. And their stop losses are going to be around this area. Same thing again. If the market starts to give trend lines, if it starts to give smart money zones, buyers are going to be loading up and they're going to be looking for that buy. Stop losses down here. Stop losses down in this area. So when we see that there's stop losses from the buyers over here because of a bullish switch and the stop loss of the seller over here because of the supply zone or triple top or whatever reason, what is the market really going to do? It's going to invite in the sellers, it's going to invite in the buyers, and it's going to take them all out. Once it's taken everyone out, it will go the opposite direction. And that's the reality of the market. Smart money trap in this zone, these sellers taken out, these buyers taken out, a real inducement identified, and then a very violent move thereafter with high confidence, high volatility, high liquidity, fast movement, therefore easily arriving to your take profit level without all of this consolidation in your zone, consolidation around your entry, coming into a bit of drawdown, frustrating you, piquing your emotions, heavy retracements to make you FOMO, get out of a trade, or to enter too aggressively. All of these emotions come when you have choppy, unpredictable price action. When you understand the inducements, you wait for the inducement of the day, you qualify it easily, and then you find effortless trades where you can find a 1 to 10 risk reward in the space of an hour or two. And I've shown you hundreds of case studies of this, of my own trades that I actually took on this channel. I've demonstrated time and time again that on an intra-session level, you can get higher win rates, high quality trades, high risk to reward, high trade frequency. This is the best way to trade because you understand the language of price. So now that we've understood the types of inducements from minor through to major inducement, let's go now and compare it to if we are inside a point of interest. If we're inducing a point of interest, this is going to be medium or major, and then we have no points of interest and what that really means. So inside of a point of interest, consider it a supply zone. We will look for Asia high, Asia low liquidity to add on top. So supply zone plus Asia high liquidity, better. Or supply zone plus medium inducement, or a minor buildup, or a smart money trap, or a trendline liquidity. These are examples that I've shown on this channel of every single one of them. For example, we have a supply zone like this. Price comes up doing the complex pullback as we arrive into the zone. Maybe this is previous day high. Then we get an Asia range over here. So we have Asia range box over here with Asia high, Asia low. We have previous day high liquidity. And then during the London session, we induce low to come higher, grab Asia high liquidity, grab previous day high liquidity. We have now grabbed and found the inducement of the day. We get a confirmed rejection in the time window and we look to sell to make a new lower low. Our goal is not to hold the whole trade. Our goal is to understand we grab liquidity of Asia high, we grab liquidity of previous day high. We are inside of a supply zone. We got the time and lower time frame confirmation and we go for an intra-session movement. For example, just down to Asia low or a market structure shift. And then this portion over here that we catch is enough for us to find our intraday 1 to 10 risk reward trade in a single day, high quality, high probability, high win rates, high risk reward, everything that you need, especially if you are a prop firm trader. But of course, just based on the criteria that are given, the previous day high would be a medium inducement. Asia high can be a type of medium inducement, but we can also get a lot more. For example, let's say we start to consolidate over here. Now we have found equal highs. So when we get a push up, smart money traders are interested. We get an invalidation criteria, so we don't get in. Then we get a smart money trap and then the real move. So now we have previous day high, Asia high, smart money trap. For the real inducement of the day, protects you from all these losses and also gives you a more quality setup. And we can keep adding to this. Let's say now price shoots up and then we start to get this bearish trend line. And then we get one more shoot up to take out that trend line liquidity and then the reversal. What happened here? We grabbed previous day high, we grabbed this trend line liquidity, and then we had the real inducement of the day and we learn how to confirm it and we get a violent move after. Why? Because the market moves based on volatility and liquidity. And liquidity brings the volatility. So when you're at the right time, in the right place, with the right liquidity, it's a perfect storm to find a high quality, real move in the market as opposed to just a mini retracement or a minor move or something that is without institutional intent. You're trading the real moves, the real market movers, and those real market structure shifts. Next category is of the point of interest. So just like a major inducement, as we spoke about, we arrive into the zone and we realize that we're getting no confirmations. Price keeps going higher into the zone and then higher into the zone and then higher into the zone, but not giving rejections or confirmations that any of these areas are inducements. Eventually, you can even buy up, and when you have that real inducement, this time of the whole zone, a major inducement, then you find the confirmations, which I'll share with you, and then you can actually trade lower. So So this way is going to help you not only avoid losses by not taking every trade inside of a point of interest, but it's also going to give you opportunities to buy when you're in a supply zone, when everyone is selling, and then when the market is ready, you can actually sell. And then lastly, we have no point of interest at all. So we're mainly going to be using medium and major inducements and the traps we mentioned in the beginning of the manipulation category. These are going to be examples when you're trading a bit counter trend or a bit more aggressive setups because there's no point of interest. But just like previously applies, let's say you're in no man's land, but you take previous week's high liquidity, you take Asia high liquidity, you get time window and you get lower time frame confirmation. You found inducement plus confirmation. You don't need a point of interest. You can actually take trades when the rest of the market is waiting for price to arrive to a correct zone. So this does beg the question, how do we understand the difference between a sweep and a smart money zone versus a real inducement? And that's all going to lie in the confirmations and invalidations, as we have also previously shared. Let me reiterate. Confirmations will simply mean rejections. Can you see a rejection in intent and that change in state of the market is going bullish and bullish and bullish, and then you see a rejection? You've now understood that that was an inducement plus rejection. Now you can expect bearish and bearish and bearish. You need to understand that conversion mechanism from bullish to bearish, where the apex, the peak, is actually the inducement. You need to identify it, confirm it, and then learn how to trade it. So first of all, we will look at identifying the inducement of the day. We need to find imbalances. We need to find structure shifts or trap forming, because not every inducement will give a structure shift. You need to understand where the traps are forming, and you trade it like a magnet is waiting and price is going towards it. You wait for the trap to be presented and then you sell into it as the trap is attacked. And then of course, obviously waiting for a market structure shift and utilizing candlestick patterns of refinements, refined IFCs, all of these criteria like momentum, speed, size of candles, all of these things will add to your confirmations. I'll elaborate later on. But the next thing you'll also need to understand is the invalidation criteria. Watch my other video where I spoke about in detail the exact invalidation criteria in my liquidity guide video. But here I'm going to speak about the time windows. The time windows, as you know, we have two. We have the London window and the New York window. I don't want to be glued to the screen, watching every inducement, watching every market movement and understanding the language, and therefore being impulsed to get in on every move, because not every move in the market is worth trading. As a professional trader, you have to understand there is a difference between what we can see, what we can read, and what we actually trade. Something that is backed by data, something that has its confluences, and you know the stats. You've qualified it as an A plus or A or B setup. You know when to use it based on your risk management, based on your account situation. Which reminds me, by the way, make sure in the link in the description, go and grab my Risk Management OS. It's a whole platform that I developed for myself that is powered by AI, powered by data, that you can remove all of your psychology, all of your decision making on what type of trade to take, on how much to risk, because it gives you a full trade log. And then based on your performance, whether you're winning or losing or in a down period or in drawdown, it will tell you exactly how to trade next, and it will be your guide in the market. Make sure you use the link in the description. It's free for the rest of your life. I don't want anything from you. It's a tool that benefited me and I wanted to share with you guys. But yes, the point here being is that you want to be restricted in time. You don't want to be trading 24/7 because it's going to be hell for your mindset, and all of the trades you will miss out on that are not in the time window, that's okay, because you will save yourself from so many weak setups, so many invalid setups, so many losses you will get rid of, because restricted is profitable. The key time windows give you the best opportunity because those are the best times of the day where real movements occur. This is data. This is not made up. The most meaningful movements in the market are concentrated in specific time windows. Yes, you will have outliers, but they are anomalies. Majority of real moves in the market happen in these key windows. So if you are trading in these key windows, you've already increased your win rates and odds. And if you are combining that time window, which is basically volatility, with liquidity that we are teaching you, this is the perfect combination. This is the time you need to be trading, and the rest of the time, go live your life. You just need to be monitoring for 2 hours a day, and you can really unlock a life of freedom. And this is the way that you should be trading. As I always say, the key to your profitability is not in more winning trades. You've taken a winning trade before. You know exactly how to win in the market. The reason you're not funded, the reason you're not making consistent payouts is because you take too many losses. So therefore, the profit you seek is not in more wins. It's in avoiding the losses that you shouldn't be taking. And the time windows, they're going to be your best friends in avoiding losses. So speaking more practically, in your London window, which is your London Open, the first hour, and your New York window, which is after New York Open trap, it's the second hour of New York. You need to identify, am I in a continuation or reversal model? And that's both for London and New York, utilizing, for example, Asia high and Asia low as your markers for continuation versus reversal. Or in the New York window, you can use the difference between a continuation and reversal between high of previous day or high of previous week, or a major inducement, or even sometimes session high and low of London session. These are the ways you'll identify it. Go watch the videos I've made on a continuation and reversal model if you're not fully aware on how this operates. So now getting into price action, I want to show you real life examples. And the main thing on the daily time frame we can see is that we've had a high in the market that had a bearish run all the way down to make a lower low. Once we had that lower low in the market, then we started the complex pullback by forming higher highs and higher lows and higher highs and higher lows, all the way with this inducement of these lows to fuel the market to come all the way to the extreme. As we arrive into this daily supply zone, I want to read through all of this price action to show you the market is bullish because we're pushing up. We arrive to a supply zone, so maybe sellers take control. We are now going to have a battle between buyers and sellers both trying because both of them are involved. And how do we read who's in control? Inducements. So let's jump down to the 5-minute time frame to see the market and price action as it's forming, and I can show you that supply and demand is not enough. Smart money concepts is certainly not enough. And let's in fact rewind all the way back to last Monday. I'm filming this today on a Monday, so let's do Monday to Monday, a full week in price action as we arrive into this daily supply zone and see sellers take control. And I want to show you that it's not all about the sellers just because we've arrived to a supply zone. And I'll be doing a walkthrough of every inducement, every market move, and showing you the realities, and you'll be blown away how inducements are so accurate, so predictable, and they don't lie. Trend lines, EMAs, indicators, Elliott wave, SMC, all of these things work sometimes. That's why people use it, but they don't always tell the truth. They're not the reality of the market. They are correlations. The reality, the truth of the market is inducements, and I'll show it to you. And by the way, you might be watching this video a few weeks or a few months after I recorded it, and you might think this is a bit outdated. So go through and watch the rest of this channel and you realize this repeats. I've been doing this for years and years. I've been documenting, I'm making videos. This is continual, constant, daily movements. This is the reality of the market. And if you want to see how to actually apply it, not just theory, not just one case study, come join me in our live trading, because I truly believe courses and education, they are useful, but the reality is it's not enough, because you've probably bought a few courses. You've probably already done some of these mentorships and you realized you still don't know what's going on. You still don't understand the market. You still can't make profit in the market. That's probably why you're watching this video. That's why inside of our incubator, we do daily live streams for London and New York session and daily recaps, multiple times a week Q&A sessions, one-on-one guidance every single week. And when you combine all of this together, if you want to really change your trading, come join us for 6 months. Go through and watch price action live every single session with us. And that's why we've had so many members that have made thousands and thousands of dollars in payouts or millions of dollars in funding per person. So if you are interested, find the link somewhere. But for now, let's jump into this price action on the 5-minute time frame. So as we arrive into the daily zone, what can we first see? What jumps out to me right away is the medium inducement. We had previous day high, this high in the market. That's what did what? Arrived into the supply zone. What did it do? It had a bit of a trend line forming. 1 touch, 2 touch, 3 touch, all the way down here. These sellers are getting in and they're getting taken out. How is the market fueling that move? How can the market take out this trend line liquidity? Well, put very simply, this liquidity became a magnet. Price was attracted to it. And what did the market need to do to grab this liquidity? It needed a bit of fuel. So we can take some of this trend line liquidity here or this low over here. We have an inducement down here. This fuels the move higher. We grab some orders, get some sellers interested, and then take them out. So now we have grabbed this trend line liquidity. What happens again? A buildup of lows, a run of liquidity to fuel the move higher. Then we come to previous day high liquidity, a wonderful liquidity pool in our supply zone. We take it out for 1 or 2 pips and then the real move happens. Price then shoots lower. After that, what do we see? Asia low liquidity with 1 touch, 2 touch, 3 touch. Triple bottom. Buyers are getting in because they see a triple bottom. No market structure shift. In fact, it's just a small buildup, a minor inducement, and then a break of structure. Remember the pattern. A buildup, a inducement, and a shift. And sometimes a mitigation and continuation. But either way, you'll have a buildup of liquidity, an inducement, and then a move lower. And that's what's happened here. A buildup of liquidity, an inducement, and a move lower to break this structure. So when price comes back into that supply zone that was actually an inducement, that's when we realize that this whole area became a trap. This trend line liquidity became a trap. So I can very confidently plot that this trend line liquidity was targeted. This minor inducement led the show temporarily, and then another buildup over here of orders leading to another inducement right here. That inducement now pushed market lower. Now, what are smart money traders thinking? Smart money traders are thinking, okay, perfect. We've had all of these equal lows, this liquidity. We are in our New York open. We've swept these lows, and then we've had a market structure shift. We've had a bullish breakout. We got all of this momentum bullish. Buyers are going to be loading up here to target higher. Smart money traders love out of context sweeps because they saw buy side, sell side liquidity. They don't understand the inducements. They don't understand the realities of this, and they don't realize this is a smart money trap. So what happens? The market does a real inducement, does a real mitigation, and then attacks that level. So I hope you're starting to see this is time and time again. The inducements run the show. This inducement allowed price to come higher to grab the trend line. This inducement of previous day high allowed the market to come lower. These small inducements allowed us to push and break that level. Then we formed a trap to grab the liquidity, and then we had the fuel to actually attack that zone. Inducements are running the show. Who cares about market structure? Who cares about Fibonacci? Who cares about all these other things that you might be using? Inducements, read it and see what's happening next. Let's continue on. As we arrive to the next day, now we are already on Wednesday, and we start to see, okay, perfect. We have this trend line liquidity right here. I'll mark it out. But as we now have a break of structure of a previous zone, we're having now a market structure shift bearish. So maybe some buyers are getting in because of that liquidity. Who knows what's going on? But what I can read is we've got this equal highs. Who likes equal highs? Smart money traders. So forget the liquidity of the support and resistance level. What about the liquidity of the smart money traders who are seeing London open, sweep of equal highs, applying to this supply zone with all of this trend line? They are going to be entering sells in this area, especially when they have the break of structure. So when you add in that break of structure, there's going to be so many sellers in this area looking for price to come lower, especially because you've had a bearish break of structure. Well, the reality is that this inducement of the left, this inducement over here of this low, fueled the move to grab this liquidity. Liquidity of what? Trend line, Asia high, smart money trap. We found a medium inducement. Perfect. Now we found the inducement of the day. The first domino, what happens? Domino, domino, domino. So this inducement was the fuel to do the inducement of the day. We found the inducement of the day. What happens next? Pushes lower, engineers liquidity, induces again, pushes lower, minor inducement of that structure. Boom. Comes lower. It's just revealing to us, and this is M5. If I showed you M1, it would be even more clear. But we can see time and time again what's happening next. Trend line liquidity forming. With that liquidity formed and this sweep over here, we get one inducement into our weak demand. Weak demand, why? Because yes, it had a bit of a switch, but it's also an inducement. So we don't know who's in control really. We just read it and we realize that, okay, sellers are in control right now. We found the inducement of the day, and then the domino, and then the domino. But now we had a counter inducement. Maybe buyers are taking control. And then we see that again. Oh, buyers are in control. We are doing minor inducements to show buyer strength, and then we are targeting the seller's liquidity. So we see a shift that buyers take control. Where could the buyers be going? Maybe to a supply level, maybe to a supply level, maybe to a supply level. So we see buyers are temporarily in control. We see where they're going. And we see first it arrives to this supply area, and then we get an inducement high. So we say, oh, maybe the sellers took control. And then we see price comes lower, comes back into that demand area right here. What happens next? Oh, we get an inducement low. That shows us that this is in control, this is in control, and this is in control, meaning the sellers are not in control. So what does that mean? This zone will fail, and maybe we look at the next zone. But then we see that inducement follow through, pushes out, takes out the supply zone, grab liquidity. Now we arrive to the next zone, and we arrive to that next zone. We see price is doing a buildup of liquidity here, a minor inducement here, a minor inducement here. What is that? That is price locked. A tug of war where both buyers and sellers are inducing. So we need to find out who's in control, because price could come to this seller's inducement, or these buyers, 1, 2, 3, 4, they could be in control. So the tug of war is happening. We see who wins that battle, and we push forward and we see, okay, we had to grab liquidity to see who would break control, because this inducement allowed price to come higher. Then we had a medium inducement, not just of session highs, but also of a structure point on M15. And where did it go to? Well, as we expected, previous inducement that ran the show, price came into that supply zone of the previous inducement. This inducement that took the smart money trap, this inducement that took the trend line, took Asia high, this medium inducement led price lower. Buyers temporarily showed us control, and then eventually came back to that area. Sellers took control again, and boom, now we're getting progress. And then we see, okay, they didn't hold control because we had this next inducement which allowed price to come higher. So we could see sometimes you get fooled, sometimes you think jump into sells because we got inducement in a valid zone and a break of structure, but inducements show us otherwise. Now, I'm not saying this is an exact science. Sometimes I'll take losses by misunderstanding an inducement, but you can start to see inducements everywhere. They are constant. They are multiple times a day, and this is just on GU. Imagine if you're looking across the market, and especially if you're on M1, you would see even more. This is continuous. This is constant. We don't trade all of them. We wait for time window. We wait for setups. We wait for confirmation. We monitor our invalidations, and we have our textbook setups that are predefined, predetermined, have their checklists and rules, and have the data behind it. So you're not coming to the market every day and hoping and wishing and trying to find everything and hoping it sticks together. That's random. That's chaos. That's going to lead to unpredictable, frustrated results. But if you want predictable, reliable, consistent profit, you make models out of this, and it becomes effortless because you come to the market in your time window and say, hey, does today's price action meet any of my criteria? If it does, I'll watch. If it doesn't, I close my laptop and I go about my day. Now, as we move forward, same thing again. This inducement over here pushed market lower. But what happened first? We had a minor inducement over here. That minor inducement pushed market higher. Then we had some build up over here, a sweep, no intent, no break of structure because it came to the supply zone, a real sweep, smart money trap that has now allowed price to come higher. Same thing, this has led to no inducement, so it's just going to push lower and then will eventually continue higher because these guys are in control. And as we continue on, we print all of this liquidity, we have this inducement low, we have this mitigation over here to push market higher. This is going on and on every single day. Build up, inducement, mitigation again and again and again. And that brings us to today's price action and then a rocket that happened today. We look back 1 week of price action and we can count how many inducements there were. There were dozens. They're continuous and they are showing us priority of every move. We can anticipate the next move in the market. We can anticipate which point of interest is a trap, which point of interest will fail, if market structure is misleading us. This is just simply the reality. If you're not trading with this, you are trading blind. And as I said at the beginning, if you cannot see the liquidity, you are the liquidity. And when you read these inducements, you'll be one step ahead. But as I mentioned, not every inducement is to trade and not every market movement is an opportunity, because the key to this is restrictions. Because as I always say, a restricted trader is a profitable trader.